Hey, it's Connie from Prosperity Finance, sharing the best financial tips so that you can be more successful with achieving your financial goals. In the previous session, I shared with you there are three types of building a property. In today's session, I'm going to explain the difference between building a new property versus buying existing property. What is the difference in terms of finance requirements? So let's begin. Firstly, let's look at the borrowing capacity or the loan amount. So when you decide to build a new property, you probably get a very similar amount approval compared to purchase a new loan. Purchase a new property. The reason being is when you do the construction, the bank actually consider the end position. So once the construction complete, how many bedrooms do you have? Can you still have two flatmates living with you, right? So if you purchase a 3-bedroom and you build 3-bedroom, both give you the potential to have a 2-border income. So there's no difference. That's why they are very similar in terms of your borrowing capacity. However, some banks will allocate 10% on top of your building contract just to cover, cost overrun. This is also applicable to a fixed price contract. You're probably wondering why, if it's a fixed, then why is cost overrun? Well, is the builder responsible for any cost overrun only if they deliver what it says in the contract. However, if you say I want to upgrade my bathroom, then you actually want something outside the contract. Therefore, additional costs won't be able to pass to the builder. So the bank have to allow those kind of cost overrun. But it's not the same for all the banks. Some just look at the contract itself, they don't add anything. Some will allocate 10%. So if your max borrowing capacity is exactly the amount you need to borrow, then it could be a difference. Some bank will lower your borrowing capacity, whereas buying a new home, they don't have to worry about cost overrun. So I would say loan amount would be very similar. It may not the same, but by choosing the right lender, we can overcome that issue. Now, the rest of them are actually the additional criteria that not applicable to purchasing existing property. So what are they? Contract, builder, what kind of builder you engage, and the registered valuation. Okay, so let's have a look at them. So contract, normally bank is happy with two main types of contract. One is called turnkey contract. Turnkey by it meaning is give you the key, you can just turn that and then go into your house, right? So that means give you everything you need for your house. Okay, you just move in. That's it. Another type is called fixed price contract. Now, some fixed price contract doesn't include small things like letterbox or landscaping. It's still livable, but it's not everything. Okay, so be careful when you sign that fixed contract. You know what's not in there. Okay, other contract the bank may not happy with. For example, if you are responsible for the material and let the builder engage plumber and electrician, carpenter, etc., the total cost can blow out. So the bank actually not very comfortable with that kind of a contract. So just so you're aware, in terms of builder, some bank must have a master builder. Okay, obviously master builder is the highest qualification. It's also there's a quality assurance, but a lot of small builders, they are not master builders, they are licensed builder. So some banks happy with licensed builder, doesn't have to master, different requirements. Okay. Finally, it's a register valuation. Well, the register valuation is required because bank has no reference to the value of the property. Unlike existing property, bank can go into the system and see what is the estimate value of this property, so I can work out my LVR based on that value. So most of the time you wouldn't need a valuation when you buy existing property. However, with the construction, obviously they need to establish a value. So they normally have two values. One is as if complete. So as if the construction has completed, what is the market value? Okay, and the second value is as is. So as is normally means what is the current value is. It depends on the progress. So if you just started, then it's just the land value. But if you already made some progress and the construction stage, then it's valued up, right, progressively. So valuation, every bank has a different requirement for that. Some banks can waive it if you have a master builder or LVI is within a certain percentage, or if the builder is master builder, etc. They're all different, right? So it's very hard to navigate by yourself, to be honest. So when we look at a construction loan, we actually look at everything, okay? So it's definitely more complex than just finance for a new property. Finance existing property. But I guess, it's still worthwhile considering construction because, as I mentioned in the last session, it gives you a lot of customization and probably save you a lot of costs compared to buying existing one. So I hope this is useful. Obviously, when you have this building requirements, it's all case by case. There's a lot of things to consider. So the best way is just to give us a call and we will guide you through. Okay. Thank you so much for watching, and if you like our content, please feel free to share with your family and friends. And if you haven't subscribed our YouTube channel, please do now, as we have a very good content share with you every week. Okay, thanks for watching. I will see you next time.